Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies, Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to deal with the subject called Investment Management. This topic for the session 46 is Performance Evaluation of Mutual Funds. Before going to discuss about this particular topic, let us understand what we discussed in the last class. To recap this previous class, we have discussed about portfolio evaluation in the previous session. The learning objective of this particular chapter is to provide an overview of portfolio management strategies, portfolio revision, and rebalancing and apply the various measures for evaluating a portfolio. Once the student attends this particular session, he will be able to evaluate the performance of mutual funds. Here, the performance evaluation of mutual funds can be evaluated from the various parameters. A. Define the investment goal. Shortlist a few peer funds to compare. Check the historical performance data. Fee structure of the fund. Risk adjusted returns. Performance against index. All these parameters that we have to keep in mind. Let us understand how performance evaluation can be done. First and foremost thing, define the investment goals. What is the purpose of the investment? The person has to decide. Answer to this should be the foundation of your mutual fund choices. For instance, if you want a regular income with capital protection, you can choose to invest in a debt fund. However, if you have a higher risk appetite and an aim to build your wealth, equities will suit your purpose. So it is crucial to define your financial goal first and then decide your investment. This also has a pivotal role in fund evaluation. Shortlist a few peer funds to compare. It is difficult to assess a mutual fund in isolation, so you should always make a small list of comparable funds and continuously compare them. There are many financial techniques, means fintech firms and third-party websites that offer free mutual fund screener tools. Check the historical performance data. Now, every mutual fund handbook comes with a disclaimer stating that past performance is no indicator of future performance. However, this data can help you check how the fund has fared across different market cycles. Consistency can also shed light on the skill of the fund manager. In short, it will be easier for you to find a fund with lower risks but higher returns. Fee structure of the fund. A mutual fund company charges you for its services and expertise. Some funds require deaf management and quick decision on whether to buy, sell or hold on to an asset. Please remember that a fund with a higher fee is automatically better. Do think out other parameters too before choosing. Risk adjusted returns. Every fund expects certain risk related to the market and the industry. When fund strategies in such a way that they make more returns against anticipated risks, we call them risk adjusted returns. Performance against index. Indexes like Nifty, BSE, Sensex, and BSE 200 set benchmarks, and all fund performance are evaluated on this basis. Comparing different timelines against the benchmark as well as peers can be insightful. A well-managed fund won't fall too hard during a market low. Here, a managed portfolio is the one which collects the funds from investors in the form of different schemes with the objective of investing these funds in a capital money market. The benefit generated from these investment activities are distributed among the contributors, unit holders. There are some of the following the category of managed portfolios. One is mutual fund, portfolio management schemes, individual portfolio of an investors managed by professionals. Performance indicators of managed portfolio. One is the performance of a managed portfolio is measured with the help of two parameters. One is returns, second one is risk. Returns. A managed portfolio invests all funds in different securities, the benefit of which is meant for the unit holders who contribute to the funds. NAV and its movement is the best tool to measure the performance of a managed portfolio mutual funds. The returns generated by a mutual fund over the holding period or over a longer period can be measured in the form of percentage returns. The returns are nothing but the uh, appreciation recorded in the NAV over a period. Returns over the holding period can be calculated like the formula. Returns is equal to NAV T minus NAV T minus 1 plus dividends divided by NAV T minus 1 into 100. NAV represents net asset value per unit. It includes value of the assets netted against the liabilities held by a mutual fund under a particular scheme at a period of time. This represents the expected value which might be received by the unit holders. If units are repurchased or surrendered for redemption or repurchase, net value per unit means NAV at the end and the NAV T minus 1 means NAV at the start of the 1 year. The other one is risk. Risk of mutual fund means managed portfolio is the variability of returns over a significant period. It may be measured in the form of standard deviation of the returns. This variability indicates expected fluctuations in the returns. This risk can be classified into two types. One is systematic risk and non-systematic risk. Systematic risk, by systematic risk, we mean risk on account of association of a mutual fund with the general market. The risk rises on account of systematic wide factors. One is inflation risk, interest rate risk, political risk, market risk, risk due to government policies, natural calamities, scams, malpractices, monsoons, industrial growth or output, industrial events, war-like situation, internal peace, like that. There are some of the advantages of mutual funds. The first advantage is it facilitates for the diversification. These mutual funds are managed by expert managers. It is helpful for immediate liquidity. It is very convenient to invest. And also it's helpful in reinvestment of income. Range of investment options and objectives are very clear. This is affordable for any investors. At the same time, disadvantages also are there. No control over portfolio. So capital gain, sometimes it gives the capital gain maybe after 1 year. Fees and expenses, managers who manage these mutual funds, they ask for fees. Over diversification also sometimes create confusions. Cash track. So always we have to keep maintaining the cash to satisfy the process of mutual funds. Dear students, in order to summarize this session, investors are keen on assessing how fund managers managing their money are performing on absolute terms and relative to other portfolios or funds. Several measures and techniques are used to evaluate the performance of portfolios, funds, and portfolio managers. Some of the multiple class questions will enable you to understand this performance evaluation of funds, mutual funds. Question number 1. What is the purpose of investment in mutual funds? Option A, for regular income. Option B, for tax benefits. Option C, for earning dividend. Option D, for security. What could be the answer for this? The answer is option A, for regular income. We have another question. When fund strategies in such a way that that investors make more returns against anticipated risks, we call them dash returns. Option A, discount free. Option B, risk adjusted. Option C, error free. Option D, tax adjusted. Any guessing answer to fill this blank? The answer is option B, risk adjusted returns. Similarly, we have another question. If an investor wants to earn a regular income with capital protection, he can choose to invest in a dash. Option A, capital fund. Option B, reserve fund. Option C, mutual fund. Option D, debt fund. Any guessing answer? The answer is option D, debt fund. Similarly, we have one more question. Dash like Nifty, BSE, Sensex and BSE 200 set benchmarks and all fund performance are evaluated on this basis. Option A, indicators. Option B, indexes. Option C, beta. Option D, companies. Which is the right answer for filling this blank? Any guess? The answer is option B, indexes. Similarly, we have one more question. A dash fund won't fall too hard during a market low. Option A, reserve. Option B, capital. Option C, cash ratio. Option D, well managed. Any guessing answer for filling this blank? The answer is option D. A well managed fund won't fall too hard during a market low. Dear students, there are many books and references are available to understand this performance evaluation of mutual funds. I recommend all of you to go through the references that we listed in this particular slide. And I thank all of you for giving me this wonderful opportunity to explain about the performance evaluation of mutual funds. I wish you all the best and good luck. Thank you very much.